Bob the Builder's ProID project. So this is the report whereby we have the business model, where we talk about the business model of AquaNova, the shop website link, the Minecraft build, a server, and all the descriptions like the SWOT analysis, the revenue build, and the micro portals 5 forces and other factors to note about this business. So in here we have the start of the floating platform assumptions. We have when the project commences. It is all dynamic and can be toggled. For example, let's go to my revenue. My revenue start date over here. See, you see here it's on February, but if I change it to be on, let's say, April, it will now start on April here. But yeah. So all these things are dynamic. We can see the area in the area in square feet to see whether the project is reasonable in cost. We also can see the development cost of this project, whereby we can see the floating platform construction, furnitures, fixtures, level 1, level 2, level 3 costs. All these expenses are in the expenses section right here in maroon, where we have our capital budget, our subscription, our utilities, and our staff salaries. And over here is where we have our project duration and our research and description of our project duration. Using the floating platform in Marina Bay as our proxy for the duration for our AquaNova construction. So after we have all our assumptions here, we also have our revenue build, where we have 4 lines of business. One is leasing out space, entry pass, memberships, and attraction sales. These 3 are very similar to the Universal Studios model, where you enter there and pay for an entry pass. The entry pass, and when you go inside there, you usually pay for things like food or souvenirs, all that things. And over here it's our cost of capital and terminal value assumption, which is which is basically what our investors want from our business and how much the business will sell for. Okay, so here we have let's skip down to the development cost. We have our one-time payments of our permits and licenses, and we have our construction of design and planning capped at 10% of the construction spending. And also it takes like we assumed it takes like 9 months, but it also can be changed. It also can be toggled. And so the remaining of the balance, we keep it in our our construction spending. And after that we need to maintain the floating platform. Therefore, we have our maintenance capital expenditure running for 40 years over here. And on our revenue build, our revenue only starts when our construction ends. Therefore, it actually starts like, I guess, 2 months after that, because we have our testing and commissioning. Therefore, we have all our revenue line items, and from there we arrive to total net revenue after subtracting our goods and services taxes. And after that, we have a cost of goods sold, licenses, and permits from our research, insurance from our research, utilities, salaries, and subscription services from our research. And we have our we also have interest, but we'll get back to it later. And because nothing is really infinite, therefore our floating platform, as we keep using it, it will incur depreciation expenses. Therefore, we also want to put that into account. And for now we make net losses. And with these net losses, we harvest them as tax losses. And after a while, as we grow our revenue from and pay higher costs due to inflation, we start to have positive net income over here at this point. And then we start to use our tax losses. Therefore, we still pay zero taxes. After our tax losses have finished been have been fi have finished we have finished using our tax losses. Therefore, we start paying tax around 2037. And from here and now let's talk about our financing assumptions. We want to be below the limit of $54 million because there's a cap. Bank loans are capped at a maximum of 75% of the property's value. Therefore, this is how much we build our property for, and therefore 75% of that is 54 million. And with this assumption, I guess we borrow for 18 months. As we borrow for 18 months, our debt increases, and therefore that translates into interest being paid, and the interest is being capped at 4% per annum on our debt balance. And we can structure our repayments in two different ways. One is our repayments as soon as we can, and the other is repayments at the end of the project. So for this case, once we start having positive cash flow in here, we can then start repaying debts. And as you can see, the debt slowly goes down to zero in this manner. Another alternative, which can be toggled, is the ending bullet repayment, where we pay our debt at the end. So let's wait for Excel to finish calculations. Yeah, so we can pay one lump sum at the end, and that also works too. It changes our returns for our shareholders, by the way. For this one, we also can change it. So like if you want 19 months, it will actually breach the limit. But yeah, that is something the model can handle. So let's put it back to 18 months, and let's recalculate this. Oh, forgot to mention that maintenance capital expenditure also can be toggled. So let's say we want to make it 40% of depreciation, and it will change. And that's really all for the monthly cash flows. Now let's move on to the three-statement financial model, where using accounting principles, we basically build out the entire financial statements, and we consolidate them into yearly instead of monthly. And we can see an broad overview of what actually happens with the business. Like let's see over here. We invest in permits and licenses for our floating platform, our pre-construction spending, and our post-construction spending over here, and our revenue only starting on 2027. And with this we build our we also take into account accounts receivables, net working capital items, borrowings and repayments right here, and also even dividends after a certain point in time. And from here, we build out our income statements, our cash flow statements, and our balance sheets, all of which are accounting financial statements. And then we put them into our discounted cash flow model to get to levered free cash flow, which is the returns investors will get. And from here, we are able to see that let me change this back to, well, actually, let's talk about this right now. See, for ending bullet repayments, investors will get back approximately 12.4% returns per annum. And that's actually pretty good. We also can change this to a repayment as soon as possible. So the returns will actually go down to 11.8%, and we want to keep it that way because it's like conservative, but it hinders investor returns. But at the same time, we can always assume that that will be paid back at the very, very end. And from here, we have we have all our returns to shareholder metrics like money over invested capital and the translated financial jargon right here. Like assuming you invest $1, you get back $39, and yeah. We also have financial health check to see whether the business would run smoothly, whether it's going to incur so much debt or not. But like for example over here, our debt ratio is actually very, very unhealthy in the first year. But as all startups are, it's normal this way. So our debt ratio is like 91%, and it will slowly grow all the way down to 0%. And yeah, all these metrics are pretty important. And also we added a section for IPOs where we use valuation methodologies to predict the share price of this company and how much it's worth. And with all these valuation methodologies, like one of them, for example, being the levered free cash flow method. Oops. And price to earnings multiple, price to book multiple, enterprise value to revenue, enterprise value to EBITDA, and enterprise value to invested capital. We predict our share price to be over here. And what this actually means is that the business, assuming there's 10 million shares outstanding, well, if its share price is now worth $1.61 million, it's now the business is now worth $16 million. And therefore, if you want to sell our business, like sell 50% of our business to the public, so it now trades on the stock exchange in 2025, we will receive $8 million. And that could actually and as you can see here, the business actually grows in value over time as it gets more stable to a value of like $450 million at the end of 40 years in 2064. And from here, and this is important because we want to expand our projects. As we expand our projects, we invest in more equipment, invest in more projects, like for example, for example over here where we have our mall plaza bill and our restaurant bill. We need money for that, and therefore we can use the money raised from the IPO to basically invest in more projects. And we also have charts over here to see that investors collectively would get $1 trillion after in a span of 40 years, and the share price over time right here. And yeah, that's about all for the financial. That's about all for our project finance model.